5 dividend ETFs that don't destroy your portfolio, that can provide steady income potential, strong dividends, diversified, low risk, and built for long-term wealth. Hey guys, it's Doug the Retirement Guy, bringing you back all of our monthly ETFs. And this one here, we're estimating about a 12% total return on this mix. So we want to help people out because we get the question so many times is it's difficult to invest. Who do I invest with? Where do I go? I just wanted to help people out and show you 5 simple, easy ETFs that you can get into, even in today's trying times. Let's get into today's video. We do have to do the disclaimer, and that is past performances don't guarantee your future results, and this information in this video is for educational and informational purposes only. I am not a licensed financial advisor. I am just one who has been studying this stuff for years. The example and suggestions discussed here are basically not suitable for all individual situations, so always contact a financial advisor before making financial decisions. The number one error is chasing yield. So many people I talk to always are chasing those big yield numbers. They're always looking, if I got 10, can I get 12? If I got 12, can I get 15? If I got 15, can I get 20? Can I get 30? Can I get 40? Everyone's always chasing yield because it's the biggest number. People understand it, and it's one of these things that can destroy a portfolio. The trap of chasing high yields is really broken down to this. The core goal of any portfolio is income must sustain the wealth, not consume it. True success is finding a lifestyle while protecting that engine. So a healthy portfolio is growing, it's stable principal value, it's sustainable and consistency for income generation, and it's true long-term wealth building. Now, the silent threat that's out there, the biggest investment mistakes don't announce themselves. They are slow, quiet, and stealthy. Eroding a portfolio is the deceptive ultra-high headline yield. When they promote big numbers over that 15 points, 15%, it's a warning sign that everyone should know is, woo, look out, what's going on. It's like the candy at the candy store of like, whoa, what is this? Shrinking principal from the NAV bleed and the slow liquidation of the funds. These are all little things that you don't pay attention to at first. It's like a slow leak on a sink. You know you have a plumbing problem because that leak has been leaking for how long? This is what happened. But yield is only half the story, okay? So chasing high yield is only half. There's another part of this. The number 2 error is NAV erosion. Now, NAV erosion, this word is thrown around across the board. You see it in YouTube videos all the time. No one really talks about the true NAV erosion, what it's about, what it does, and how it affects principles. Most people say NAV erosion is when the price goes down. So if you take a look at the stock market from Friday, you would say we had NAV erosion because the price went down. Totally false. Net asset value, which is what NAV represents. Net asset value. The true underlying value of all assets inside of an ETF that's divided by the total number of shares outstanding. Basically, what's the value of the fund divided by the number of shares gives you what the net asset value per share comes into. Okay? Now, what is the NAV erosion? Well, NAV erosion is basically, think of it this way. If you have your employees, or if you're an employee and you're working and you're not putting out enough productivity to pay your wages, you're actually a NAV erosion type person. Income earned from a fund of $5,000 and the fund pays out $5,000, in distributions is a healthy principal program. If you have erosion scenario, so that means your portfolio, it generates $5,000 but pays out $12,000. There's a $7,000 shortfall from the principal, and that has to come out of the principal. So ETF funds do this, and you'll see this across the board, that they promote and advertise something called return of capital. Now, I've said this many a times that it's a double-edged sword. So they use it as a return of capital is for tax purposes, but they can also use it as returning of your principal because they didn't earn enough money to give you the distribution that they want to promote. Number 3 error, 100% portfolio covered calls. Yep, I'm going to say covered calls does have a negative to it, and that is 100% portfolio coverage. Now, why covered calls, the ETFs have a risk decay? Well, you have to look at how it works. They buy stock or buy, there's plenty of them out there that buy options and they buy synthetics and all this kind of stuff. But basically a plain Jane plan is buy stocks. They set up and sell call options to collect the premium. That's how the system works. Now, the catch in all of this is the upside cap mechanism. Selling call options creates a price ceiling. In strong bull markets, the ETF cannot participate in the gains beyond the strike price. And I'll stop there for right now. What does that mean? If you go ahead and you have your house, you put it up for sale. Someone comes in and offers you $100,000 for your house. You take it. You agree to it. You sign the purchase agreement, and you got to close in 90 days. Well, in those 90 days, what happens if the price of your house now skyrockets up to $200,000? You agreed to sell it for $100,000, and the price of the house is now worth $200,000. This is what's going on in these options. They have agreed to sell their options, their stocks at a certain price, paid a premium to get that option, and now if the stock goes up, they don't get that increase. So this is why, while remaining fully exposed to the market downturns, these portfolios have the cap on the upside and full downside risk. The fund I show first off is QYLD, the Global X NASDAQ 100. I've talked about this one. It's a fund that's out there. I'm so onto it. It's not me personally promoting anything, but the price return has fallen 2% per year over the last decade. It sells call options on 100% of the portfolio, capping all of its growth. Investors missed the massive NASDAQ 100 upside. Okay, look at the numbers. I do a comparison. Total return 7.94% compared to QQQI's 13.63%. That's almost double the return. The other one I use, IWMY, the Defiance Russell 2000. Now this thing targets an aggressive 30% annual distribution yield, but heavily reliant on that return of capital distribution. Now they promote it as a tax advantage, but it gives them the opportunity to pay back your own principal to keep that 30% going. So literally you're returning your own principal as income if they need to use that return of capital. So the 5 dividend ETFs that don't destroy your portfolio, these things are going to fix the first 3 items. They don't have these things part of it. And this is what helps you build a portfolio for long term. Now the first fund of the 5, I really call it the gold standard. And you've probably seen it many, many times. And the distribution actually probably shocks you and says, why do you even talk about these? And that is the Charles Schwab U.S. Dividend Equity ETF, SCHD. Now this has always been called the gold standard fund for strategies, for operations, and so on. Let's first cover that yield. Remember, we're not chasing yield what we're looking at is total package, the total return of the fund. Now, distributions about 3.25% distributions. The total return is at 23.30%, which means we have just a little bit over a 20% growth in the fund. So as the fund grows, that distribution number will always be changing. This is why that yield doesn't really always mean everything that it needs to stand up to. The quality first methodology that they use at Charles Schwab focused on fundamental strong companies with quality balance sheets and consistent cash flows. The dividend growth engine invests in firms with a proven history of raising payouts, ensuring that the income stream becomes pace with inflation. And then that NAV preservation, unlike eroding high yield funds, SCHD underlying value grows along with its distributions. The best thing of this fund ever to do is not look at it as of today. Actually, the best thing is to look in the past. Now, I know the past does not always guarantee the future, but look what's happened. I personally own SCHD, and I've had it now for probably close to 10 years. My distributions now are higher than 3% because I bought so low, and the value has come up that my yield is much, much higher than 3.25%. So this is one of those that you have great growth, good distributions across the board. Now our next fund is Amplified CWP Growth and Income ETF QDVO. Now this fund here, you can see the distribution is a little bit better what most people are looking for. They want that 10.38% distribution. But when I look at total return, I'm looking at this fund of a 10% yield with about a 17% growth factor. So I'm seeing a positive on both sides of it. Now, the proof of the anti-erosion record is the genuine earnings and distributions. Unlike trapped funds, QDVO demonstrates that the real earnings and premiums and not just return of capital. Its zero distribution cuts driven by the capital erosion and principal stays intact and grows. It's a quiet performer. It outperforms the flashier 30% yields in total returns and avoiding that downward blend. It's just the quiet one. A lot of people say, I never heard of it. It's been there to help people win this situation. Next one, JP Morgan. It's the NASDAQ Equity Premium Income ETF JEPQ. Now this one you probably heard of. Now because it's based off of the NASDAQ 100, we're looking at that 10.39% distributions, a 28.86% total return. Okay, so now again, we're back to that 18+% return. Now the tech heavy NASDAQ 100 focus with the JPQ framework, it captures growth from that tech sector while generating yield. The NAV is actually trending upwards since May of 2022 when this fund launched. So it is just one of those funds, especially in retirement funds. JPQ is a very, very strong piece in a strong portfolio. Now our next fund gets into probably the one that most popular out there that a lot of people have heard of and been investing into since NEOS came out with these funds. It's the NEOS S&P 500 High Income ETF, SPYI. Now, the unique with this one, man, I'll tell you, there are so many things to talk about SPYI, and we've done a video on it. And to give you the insight, this one gives you great income today, strong returns for tomorrow, and they use the tax efficiency across the board. Distributions 11.87% with a 23.40 total return. Again, guys, broken record. We're looking at a 12% growth with 11% distribution. Some very, very strong numbers. This is where I can see that if my yield is at 11 and my total returns at 23, I got a good certainty that they're doing the right thing, that my fund is growing as my distributions come out. Now, this is a partial covered call strategy. A lot of people don't know that. NEOS only gives a partial cover of their portfolio. is only partially covered. So we're not worrying about that downward bleed that you get from that 100% covered calls. It does work with the index of the S&P 500 and gives you that broad coverage exposure, but you're not really working with a 100% coverage. So you can capture some of the upside, you got a little downside protection, and it just works back and forth. And then the number 5 fund is the sister or brother, however you want to put it, of the NEOS NASDAQ 100 High Income ETF QQQI. This one here, look at the numbers. Now we know QQQ, the NASDAQ 100, has had a great strong run. This one shows at 13.79% in distributions. And it's funny, everything I showed you, you can see everything's under that 15% in the yield side of it. And it shows you where safer marks come into is you can still get higher yields, but still stay under the 15% mark and see your total returns growth. So we're looking at 30%, another 17% growth versus a 13% income. Now, innovation of this one uses that partial coverage to capture the bull market rallies while it delivered at 12 to 14% yield. That's why this has been so strong. The technology of the NASDAQ 100 has been so strong lately that it's really had a bull run through these times. So the 5 dividend ETFs that don't destroy your portfolio is listed right here. Even though at Charles Schwab at 3.25% yield, which most people would say not interested, won't do anything for you. Long-term game, long-term play, very strong. I use this a lot in my foundation buckets. If you know me at all, you know I have a 3-bucket system, which I use foundation, growth, and income. The Charles Schwab one, hands down, is really heavily into my foundation side of it. I also use QDVO that you can see in the growth side of it, because if you take, even with 10%, if you take and roll that 10% into buying more and more funds, buying more and more shares, things can really develop. You're talking a 27% growth at year in, year out. That's huge numbers. Now we got to have some income to spend some money on. Well, we got SPYI, QQQI, and actually JEPQ. All of these go into my income portfolio because I want that 11-12% average across the board. So strong income, strong returns build for long-term successes. And if you'll take a look at it, we're not all heavily into NASDAQ. We got S&P 500 in there. We have the top dividend funds. We have some good, solid, broad diversification. So here's the answer. The sustainable income checklist. Number 1, check your total return. Don't chase the yields. Don't be the first one to look at yield and say, how's it doing? It's not about yield. Verify the share price is flat or trending upwards over a multiple year period. Immediately avoid funds with sudden downward bleeding NAV lines. That is erosion in action. When you look at positive total returns, and when you can look at positive total returns over multi-year periods, you're more safer than you may think right off the bat. Then you can turn around and look at the yields, and you can look at the total growth and get a better answer of what actually is going on. Identify the cash source. Determine where the yield originates from. If we're selling covered calls, are you doing on 100% of the portfolio? You know the problem's there. You're not going to get much growth. Want to know where that's coming from. We want to know real earnings. And the option premiums are going to be healthy. We want to evaluate the trade-off. If you're sacrificing too much upside capture for cash flow, you don't immediately need. Optimize for the yield to express the total return can quietly liquidate your long-term wealth. Okay, what I'm saying here is look at the upside capture. If we are giving up, a fund to get 10% or 20% or even 30% like we showed in the video, if we're doing 30% and we're giving up 10 or 15% in growth, you're not getting full 30. So it depends on where you're at in your retirement package, where you're heading to. If you're just getting into retirement, you're probably trying to move towards more cash flow income. If you're in your 40s and you're still trying to build, you can really start building towards that growth and take that yield and roll it into dripping and growing faster. A portfolio that preserves the NAV generates real income and compounds over time. It can do a lot more work than people give it credit for. And there's a lot of people did not really get that yield is actually a false number in a lot of cases. Guys, let me know what your thoughts are. If you haven't yet, hit that subscribe button. And best of all, to help the YouTube algorithm, please hit that like button. Leave a comment down below. I'd love to hear your thoughts on everything that we do.
Thank you for watching. Press the